Everyone wants to earn from stock market and gets excited when they hear that people are earning hundreds, thousands and even millions from stock market. But the new investors or the beginners end up losing so much money that they were not ready for. But what is the reason behind this? There may be some advanced things, but the most important thing is lack of knowledge, and as you all know, half knowledge is always dangerous. Whether it is a stock market or any other thing in the life, basics are a fundamental. So in this video, we are going to learn about the basic terms of the stock market. This video will be done in two parts because there are 50 plus terms. So without further delay, let's explore them one by one. Number 1. Arbitrage. Arbitrage refers to purchasing an asset from one market and selling it to the another market where the selling price is higher than what you paid for it, resulting in profit. Number 2. Ask. An ask is the selling price that a trader offers for their shares. Number 3. Asset allocation. Asset allocation is an investment strategy that aims to balance risk and reward by dividing a certain percentage of investments like stocks, bonds, real estate, cash, etc. across different assets in an investment portfolio. Number 4. Asset classes. Asset classes are categories of assets such as stocks, bonds, real estate or cash. Number 5. Averaging down. Averaging down is an investing strategy that involves buying additional shares of an asset or stock after its price has fallen, resulting in a lower average purchase price. Number 6. Bear market. A bear market is a market condition in which prices are expected to fall. Typically, this entails major indexes or stocks decreasing by 20% or more compared to previous highs. Number 7. Beta. Beta is the measure of an asset's risk in relation to the market. A stock with a beta of 1.5 means that the stock typically moves 50% more than the market in the same direction. Generally, a higher beta indicates a risky investment. If the market rises 10%, the stock will rise by 15%, but if the market falls by 10%, the stock will fall by 15%. Number 8. Bid. The price of a trader is willing to pay for shares of a stock or other asset. Number 9. Bid-ask spread. Bid-ask spread is the difference between what buyers are willing to pay and what price sellers are asking for a stock. Number 10. A blockchain. A blockchain is a record-keeping database in which transactions made in Bitcoin or other cryptocurrencies are recorded across multiple computers and distributed across the entire network of those computers. Blue chip stocks. Blue chip stocks are common stocks of well-known companies known for their quality and history of growth. Number 12. Bond. A bond is a type of security loaned by an investor to a borrower like a company or government used to fund its operations. Number 13. Bull market. A bull market is a market condition in which prices are expected to rise. Number 14. Buyback. A buyback is when a company purchases outstanding shares to reduce the number of shares on the market and return profits to their investors, resulting in an increased value of the remaining shares. Number 15. Capitalization. Also known as the market cap. Capitalization is the total market value of all a company's outstanding shares. It is calculated by multiplying the total number of shares by the current share price. Number 16. Capital gains. Capital gains refer to the profit earned after selling an asset or investment for a higher price than you paid for it. Number 17. Common stock. This is one of the most basic stock market terms to know. Common stock is a type of security that represents ownership in a company. Holders of a common stock are able to vote on matters like corporate policies and elect directors within that company. Number 18. Current ratio. The current ratio is a measure of a company's ability to pay short-term debt. It is determined by dividing current assets by current liabilities. Number 19. Day trading. Day trading is the practice of buying and selling shares of a stock market within a single day. Number 20. Debt to equity ratio. Debt to equity ratio represents a function of a company's debt relative to its equity, or the value of its assets minus its liabilities. The ratio is bound by dividing total liabilities by the total shareholder equity. 21. Diversification. Diversification is an investment strategy that divides investment funds across a variety of assets in order to minimize overall risk. Number 2. Dividend. Dividend is again one of the most basic terms for the stock market. It is simply a portion of a company's earnings paid out to its shareholders. Number 23. Dividend yield. A dividend yield is a dividend expressed as a percentage of its stock price. Number 24. Dollar cost averaging. Dollar cost averaging is an investment strategy in which you invest a fixed amount on a regular basis regardless of the price of the asset. Dow Jones Industrial Average, also known as Dow 30, the Dow Jones Industrial Average is a stock market index consisting of the 30 most traded blue chip stocks on the New York Stock Exchange. It is used to measure the performance of shares among the largest US companies and gauge the overall direction of stock prices. 26. Earnings per share (EPS). Earnings per share is a company's profit divided by its number of outstanding shares and is used to measure corporate profitability. 27. Economic bubble. An economic bubble is a situation where asset prices surge to significantly higher levels than the fundamental value of that asset. 28. Equal weight rating. An equal weight rating is a measure used by equity analysts to signify how well a stock is performing relative to other stock. An equal weight rating suggests that a stock will perform slightly similar with the average of all the stocks being used for comparison. 29. Equity income. Equity income is used to describe any income received from stock dividends. 30. Exchange. An exchange or a stock exchange is a marketplace where investors and traders buy and sell stocks. You have probably heard of the most well-known exchanges in the US, the New York Stock Exchange, NYSE, and NASDAQ. 31. Exchange Traded Funds (ETFs). Commonly known as ETFs, exchange traded funds are a collection of stocks or bonds combined in a single fund that can be purchased and traded on major stock exchanges. Similar to mutual funds, they are a pooled investment fund, meaning a pool of money aggregated from multiple investors. 32. Expense ratio. An expense ratio measures the cost of owning a mutual fund, including expenses like the management of the fund, overhead fees, and any other cost associated with running the fund. It is essentially an administrative fee paid to the company in return for owning the fund. The ratio is measured as a percentage of your total investment. For example, if you invest $10,000 in a fund with an expense ratio of 20%, you will pay $20 on top of your investment. 33. Futures. A future is a contract that requires a buyer to purchase a specific asset and the seller to sell that asset at a certain future date at an agreed upon price. Futures are a way for investors to hedge current investments a risk management strategy intended to offset potential losses in other investments. 34. Going long. Going long refers to the act of buying stock shares with the expectation that the asset's price will rise, resulting in a profit. 35. Going short. Going short, the opposite of going long, refers to the act of selling stock shares with the expectation that the price will fall. When an investor goes short on an asset, they borrow that asset, sell it, and hopefully purchase it later at a lower price if the price goes decline, resulting in profit.